Okay, Sunday, October 30th, 2016. I'm going to go through here the bullish percent index for sectors. Now, what it is for bullish, they use point and figure charts. I enjoy point and figure charts because they take out the horizontal time and they just have price on there. So if the point and figure chart is bullish, it'll add to this index. Starting off with the telecom sector, okay, this isn't a very pretty chart due to the fact that we're, I'll just say oligopoly. I think the top 4 carriers own 97% of the market. The only one that's the disruptor right now is T-Mobile. We need prices to come down on cell phones here. Last Monday or last Saturday, when I did the videos, the Time Warner AT&T merger was announced. And of course, I was looking for a Monday high and rest of the week sell-off on that news. It just didn't develop, okay? Since I'm bearish overall for equities, any type of opportunity like that, I would look to sell into it, because what I'm looking for is I'm looking for willing participants to take my other side of my trades, okay? I mostly, I stick to basically right now currency markets, just due to the leverage it makes it up other places, because I want to, you know, as an analyst, you know, I try to explain to people this is how this works. There are 3 people in an airplane in the cockpit. There's the pilot, co-pilot, navigator. I am the navigator, okay, so I'm not the pilot. So of the 3 of those, I would probably be the co-pilot and the navigator, but my strong point overall is navigator. It's kind of like Michael Jordan in baseball. He may be very, you know, does a fine job at basketball, but baseball, you know, throws him for a loop. So it's the same thing. Like I said, I'm a navigator. I'm the fishing guy to get you to the hole, but it's your job to do the fishing. All right. So for me to keep trying of a non-biased type outlook, I try to stick to stuff that I don't talk about much, just so there's, you know, I don't want to talk my book up, as they say. And it's just like people who paper trade or whatever, blah blah blah. They seem to do a better job. It's the same thing once you throw in that the money thing in there, you begin to focus on other things, bills being paid, the spouse, whatever, and that can affect your trading, even if you do have a plan. And I always have a plan. All right, so the telecom sector here. All right. They buried the needle at 100 on here, okay? So when you're number 1, you can only go down, right? Okay, so we're getting some rollover here in the sector. I assume that the type of merger that we're looking for was, it was a content merger. They talked about vertical integration. But what I'm looking at here is that we got rid of are they called twisted pairs? No. We got rid of the landlines, okay? So about 20 years ago, we started dropping off with the landlines. Okay. Then we all got cable. Okay. Then all of a sudden, now we're not buying the services from the cable TV. We're using it for the internet. Okay. So I'm going to assume eventually here, we'll all have our internet and our TV and everything else will come through on cell. That's what I'm going to assume, which is we're all going to be wireless, okay? Which is a sad fact in itself, is that we're not printing books. The stuff is digital. Now it's in the cloud. I mean, poof, it's gone. So when the Martians show up and they scour our garbage dumps of history, they'll find a huge gap between what's in the cloud and what's on our shelves. So on the telecom here, I'm going to assume that there's going to be fighting going on here. If somebody, a price war, it's beneficial in general for the consumer. But like I always mention, you know, what a phone home landline was $24 in the 80s, and now some of us are paying 120 bucks a month. You know, yes, it's smartphones and stuff, but, you know, sure, I can use 2 terabytes of data at home and then be limited to, well, whatever, 20 gigs. I'm unlimited though, but you catch my drift. So in the telecom sector here, if we're going to have a price war, it's going to affect them, buyouts and stuff. They accumulate debt. If they dilute their stock by issuing more stock to pay for these things, and these mergers aren't, you know, hundreds of millions anymore, they're billions of dollars, and eventually all of this debt that we're doing, selling the debt, buying back the stock, it will come back to haunt us down the road. I think that when they talk about following the money, I think that's what we're going to do, because of, as the baby boomers move on and past their wealth, we're going to have a bout of inflation, because it's trillions of dollars worth of wealth, everything. It'll affect homes, everything. So for right now on the telecom sector, communication is #1 type of thing. So any type of weakness, and what I'm looking for is some sort of sharp pullback in equities here. If we get some continuation, telecom would probably be on my shopping list, because that's how we can't live basically without our cell phones. Most of them, I think more than half of the surfing now is done by your phone. So if you have a computer in the room in your home, it's a wasted space per se. So on the telecoms, if we do get a hard slide, I'd be interested in going there. Okay, technology here. Okay. We are in that cycle of technology. The secular commodity cycle is over. So typically you buy your growth stocks, like your Russells, and your technology. I talked about, I think late last year, about business services, software, things of that nature as what you want to go into. We've had a pretty good move in technology. We're seeing mergers, which means that companies are running into problems here. They merge and lay people off. The only thing they can really cut, besides their prices, is labor. So when you see the excitement of companies merging, that sometimes isn't a very good sign. Sometimes mega mergers also call into tops. We're back to Time Warner and AOL, for example. So the technology, I like the short side of things. That was the TECS. So it's a Tom, Edward, Charlie, Sam, Tex. The short side of it, instead of buying options, calls or puts, you have TEX, TECS, and TECL. Okay, they're not heavily traded because of they haven't hit the top 10 yet, but I assume when they get to extremes, just like Lab U and Lab D, people get involved. But the text, I like the short side of it, just like we saw with the chips with Intel coming off. Then you have that dichotomy of, then you have people talking about mergers. Usually when you get that's last gasp. And these huge multiple percentage moves, plus or minus, in some of these stocks, in general, usually is a sign of a trend change. When volatility picks up, there's usually a trend change. I like the short side. We have, I believe, Facebook this week for earnings. And, we saw with what happened with Apple, Microsoft went up. Mentioned that Microsoft is the cloud over at the college, so that's where they're at. But also remember that it's taken 15, 16 years for Microsoft to get back to the highs. All right, so things like Apple, I assume Apple has jumped the shark. I compare Apple to Sony of the Walkman of the 80s. The same thing. This is just how marketing is. Okay, think about this one. Even with your competitor blown out of the water, per se, Samsung, this is all you could muster. And then earnings, I think Apple's earnings peaked. I think it was 2014 at like $14 and change. You know, the guys in the chat rooms aren't talking about buybacks. You know, it's you know, they have debt. Remember, Apple has debt now. So, you know, I like the short side of technology for now. The Russell broke below 1200, so it's kind of out of the trading range. The NASDAQ, I usually talk about the strongest being the weakest, so the NASDAQ should lead her way down since the New York Stock Exchange and the Russell peaked in 2015. A lot of things peaked in May of 2015. I didn't know at the time that my short side of that popped up in May of 2015 would actually be would last as long as it did. We had the August crack in currencies with China on a hard sell-off, and then it recovered. Not much of a Christmas holiday rally, year-end rally, and then we had the swoon in January and February, and then we had Brexit in late June, and then the next swing up, I basically said, you guys are on your own. The last 10%, which I'll just say the 2400, 2350, 2400 on the S&P, will be the end of a swing for now. We need a definite healthy correction. We're getting a rolling correction, as they say. Stocks in the background are getting clubbed. Look at IBM, that peaked in 2013. You can just see it. Apple peaked 2015, you know, things of that nature. So there is a rolling correction going on behind the scenes. But we're not, the whole indexes in general, the Russell, it goes back to people are told to index. So if you're indexing 40 stocks or 100 stocks, you know, Vanguard or what have you, the money just keeps rolling in there. But you know, for me to change my tune on a bearish outlook, we'd have to have a broad-based rally here. And I just, for right now, I just don't see it. Technology, I do like the short side. TECS is the way that I'm going on that one. Like I said, it is kind of thin, but it, you know, you don't have to keep buying options on the top 10, top 20 stocks. You can have it in general. Dow Jones, bullish percent here. So this is out of 30 stocks. So this is 100%. So, you know, 75% of them. So it's at 20, 23, somewhere in there. Of the stocks are in a bullish phase and the rest are in a bearish phase. You can see the August low dropped down to 16. The 2011 low dropped down to 23%. Here's 36% for Brexit. Here's an interesting one, okay? You have indexes, say like the NASDAQ, that made a higher high, but then all of a sudden you don't have the follow through with the underlying support. And that's when I post the New York Stock Exchange and the NASDAQ composite with the pink dots, that chart that shows the underlying, the summation index of the number of shares that are contributed. And remember, we've moved up for a long time. So some people talk about the end of the business cycle. In theory, in the large macro scale, we should continue to purchase vehicles, albeit we don't have the baby boomers. I guess the number of vehicles sales per year peaked in 1985. So we don't have that tailwind anymore. The baby boomers. What I think is going to happen is the baby boomers are beginning to come out of the marketplace, labor market, and I think we're going to have a shortage right away of labor. When the ambulance driver is getting $8.69 an hour, it's tough to get people to get off the couch and at least go to college, you know, and incur that exponential debt and to go get a job because everything's been pretty well decimated. You know, it's their vision of what's out there in the labor market. You know, the healthcare costs and school costs, but that doesn't really guarantee anything. We're going to need a lot more entrepreneurial effort here. It will change. The times, you know, the times be a changing, Bob Dylan. So, you know, we will, I believe that we will see a gap in the labor market, which will spike inflation that way, because that's basically what inflation is in the United States, is our wages. And, you know, wages have been depressed since 2000. you know, that's a lot of psychological there. It's just not out there. It's just not, you know, they live within their means. As you get older, it's down, and hey, downsizing in your 30s, huh? You know, but it's happening. So, but on here on the Dow, I believe was the best on Friday's action to kind of hold it together. But I would be looking to take the short side of equities. On the next slide down should be a hard slide, like a wave 3 type of thing. And it's going to be precipitous. That should start off, for me, a multi-month correction. Like I said, I'm looking for some sort of hard slide, not as much as a bear market. But as the time, you know, goes by, depends upon how I change my tune. I'm a forward thinker, big picture, anticipatory. So you know, if somebody says, hey, what do you think about silver? I'd probably be in, you know, earlier, you know, which also, it's kind of like if the market does what I think it's going to do, and here I am in, you know, at the old high saying, you know, you're on your own, gave you about a 4-month lead time here to adjust your portfolios. And 4 months is a pretty good amount of time for even the large portfolios to hedge. Ample opportunity to either hedge or get out of things. Would I recommend, well, that's not a word I can use, but you know, you still have to, you know, you have the whole tax thing. Okay, so the easiest way to do it is either through buying options or futures. And futures, it works out if you want to short your portfolio by shorting the futures. Because when if things slide, you lift your futures and voila, you have money to buy in. You didn't incur taxes. Because think about it this way, is if you sell up here and your stuff does sell off, and you get back in, you know, you kind of took a chunk out of there with taxes. So it's a compounding interest. And even just like with the Great Depression, it's all in the time. Even if, say, we slide to something even worse than the 666 that we slid last time, say we slide to 500 for whatever reason. It's just start buying in the grandkids name, because that one took 25 years, and you saw with what happened with Microsoft. So eventually it's just the time, the hubris comes out and new technology and new things come in, and that's why the market seems to only go up. But I'm just a wee bit cautious here. It is tough, you know, when you're at the tail end of something running a prolonged up move in the market, and you jump on your box and say, hey, I think the party's over, you're on your own. I'm going to take a lot of crap. And like I mentioned before, the more crap I take, the more dead on I'm on. I watched of all movies last night. I watched The Big Short for the first time, and then I watched Rounders. So I watched The Big Short set up there, and that was difficult. They had to go out and actually make their own product, right? The swaps, and then Rounders for Psychology, which was interesting. I'm not a gambler per se. You know, what I'll do is keep my bet on the line or whatever, and just can you roll 3 7s in a row? You know, statistically, you should be able to get 8. Okay, statistically, so. You know, in a row, you get your point in a row. Okay. So, and also I think if you go downtown in Vegas to the Golden, what's it called? Not the Golden Nugget, the other one. Gold Coast? No. Golden Gate, excuse me, Golden Gate. Okay, that one, they have a wall of the number of points in a row. Hey, Kev. Don't know much about the gambling. It's random. But that's the kind of thing. For me, I look at the risk side of things here. That's how I usually weigh it. My biggest issue is that I can be early. Okay, So, which would affect things like if I say get short and all of a sudden you start buying weekly puts. You know, I went with the 4 months lead time again because I looked at my lead time with August of 15. I turned bearish in May, which was basically a global top. And then it swooned in August. And then I said, you know, we're at 1800. And I said, we're, you know, 2016, I'm looking for 2400. You know, so I caught grief both ways. But it's you know, my thing is that it's the plan is there. It's, you just have to have the patience. You know, you're looking to kind of look at this. This is from 2011 on here, and you basically just can kind of say, hey, if they go below 30%, I want to buy the Dow. Well, this is, you know, what, 1, 2, 3 times in the last 5 years. So that's that kind of patience. Okay, and here we have, you know, beginning of the year, the top thing. So, you know, we're talking, you know, months here. You know, internally the Dow did peak, obviously back in April, May. So I guess a 1-year anniversary. That's been, you know, coming off since. So internally, not price. So on the Dow here, remember it's a goofy index with 30 of them, and it's price weighted. So, but I would look to short the Dow side, but I'd rather go after like short the S&P and short the NASDAQ. Okay, because if everybody piles into like one index, like the NASDAQ, they all piled in there, Amazon, Google, Apple, on and on and on, pile in there. The narrow, it's fewer and fewer and narrower. You know, whatever money was left, all piled into the NASDAQ. While that, like I said, when the strongest becomes the weakest. Okay. Gave you basically, I was only going to talk for 20 minutes on this group of indexes here, but I'm giving you the whole thing. So that works out. Okay. And here is the composite for Canada. All right. I talked about the strong dollar. The next videos I do will be on commodities. We're talking about the dollar and everything. But short term here, we may get a pullback in the dollar and some interesting moves in commodities. And I'll go through that later. But for right now, say like Australia and Canada, any strength, I would use it to get out of it. I think that eventually the dollar, you know, we're talking years going forward here, the dollar's going to pinch commodity prices. I think the secular cycle is over into the late 2020s to very early 2030s markets. It's a long cycle. You can look at it as if commodities peaked in 1980 and then troughed again in, we'll say, 1997. That's 17 years. So if we use the peak of 2011, 17 years would be about 2028. The real estate cycle should peak in the United States at 2024 on an 18.3-year cycle. Okay, so what I'm getting at is that we may get an up move here early, to a tradable one. But I'm also seeing some interesting setups in soybeans, wheat, copper. I thought would be going sideways here, but I noticed in the back months there's been a lot of volume piling in here, and I'm going to go off of my gut instinct, which may be kind of confusing with what's on the chart. So it's either my gut's going to be wrong, which it usually isn't, and compared to what's on the chart. Lately, I've been talking about gold falling apart, but with silver, silver's an interesting setup. So don't get too bearish on gold just quite yet. I did have a target back in November and December when I talked at 1050 about gold going to 1400. I believe for 2017, 1425 is the area. And remember that even though I'm basically looking at the psychology here, okay, that's basically what technical analysis is, you know, let's just say I look at the charts with more ears than eyes. Okay, listen to what everybody's, not what they're saying, and how they're saying it. Okay, I used to be in other fluid chat rooms, And at market tops, the guys would be talking about cars, replacement needs, everything other than business. You know, there's nothing like spending 8 hours or more in a chat room and all of a sudden they're talking about milling wheat machines and stuff. That told me, you know, that they're not paying attention. And they're, you know, cognitive dissonance too. I may be under a little bit of that here too. When I was talking about that the commodity with the strong dollar and the commodities would be under pressure. Let's take natural gas, for example. Even though I said that I don't think this winter is going to set up for a move for commodities or for natural gas, I have to, that's my cognitive dissonance, even though the weather report might be right, the traders could be wrong. If you go back and look at soybeans through the 80s, 70s, and 80s, kind of every 4 years, right? So you had, you know, 1980, 1984, 1988, and you assumed in 1992. Well, they piled in there, and I'm going to do a little more research there. Piled in there, but it didn't develop. The drought didn't develop. It did develop in 96. Okay. So there may be other things too, is that if these guys can ride a losing trade, Glencore and all these, you know, they can, I assume they can get caught the other way too. That they may run these things when it's not prudent and catch, say, shorts on the wrong side, like that cotton trade for Glencore. It wasn't there in the weather. They just wouldn't give up their short and it cost them billions, which is nice because we get a piece of that, right? Zero-sum game. But on any strength that we see here, I would say probably going into February, or are we at November? Typically, February is a commodity low. Okay, the guys turn in their grains and oil seeds, and then go to New York and get the money to buy the seeds and stuff. So if we do see a continuation of the commodity move, I might say that we might get a peak in February. It'd be counter-cyclical, and that happens, which would be a perfect thing for it to slide commodities, then to slide hard. If 2017 ends up being a very normal bumper crop year there, like the natural gas, I was kind of watching on the natural gas that I would buy the next downturn, but now that we've basically cleaned everybody out, there are no longs. So then I want to be long on this one. So I may, you can put on spreads. Okay, like say you buy March and April contracts in short August. Okay, so you're not necessarily biased. You're just kind of playing the spread. And I'll do a video just on natural gas alone here as I finish these up. But okay, so anything on any strong move in Toronto Stock Exchange here, I'd play the short side. They have issues. Like in the early 80s when it was good for America, it was bad for them. So, and then they have their real estate and everything else. S&P 100, this is a big thing in the early 80s before we got the S&P futures. As you can see, their previous highs on here basically did moved higher on fewer issues. Okay. Like I said, depending upon what you're focused on and playing, I like the short side. Like I said, things are getting narrower and narrower here. We're approaching the highs, and internally they peaked prior on. So, like I said, short side of things for now. I'm going to try and figure out what would actually turn me bullish in the short term. But like I said, a lot of these stocks have had indexes have had rolling corrections behind the scenes, and that would be the only way that I can see that the indexes go higher, is that all those issues that have been beaten up behind people go shopping for value. Okay, financial sector, these are any type of hard slide, insurance and banking and finance, and that I'd be interested in, because we're in that cycle. If we're in a real estate, the upswing of the real estate cycle here, we're not at the blow off stage yet. That would probably be after the next recession. I would be in the banks sectors, because as interest rates go higher, even if we have a repeat of the 1930s, by the time you get to the 40s and 50s, you had higher interest rates again. And so that's how I'm kind of looking at it. There's still opportunities here, the old once in a lifetime type deal. So any type of hard slide in indexes, I would look to go after like the banks, insurance companies, and things of that nature. But as of right, you can see it, as of right now, it's just not working. And that's because of margins. They're making it up in fees. And what was it? Bond trading. It's everything else in traditional banking. Where's that toaster? I know. Yeah, they'd be better off if they just, if they're going to fee us, if they just gave us a gift card to go to Fry's or something, right? Yeah, you can take the $35, but give me $25 back and spend. That would help out the economy, right? One time you're giving away free toasters and stuff, and the next, now it's like I have to pay you to store my money, But that's the times that we be living in, which is going to be interesting too when the textbooks for college students come out in the next couple of years. How to fund trillions of dollars at zero interest rates. All right, so the financial sector, any type of pullback, I wouldn't be as much of a fast kind of guy here. I would rather, it's a lot easier for me to short an index or that way, or buy puts on market sliding than go run around and individually play it. I'm just an analyst. I'm not a portfolio manager, so I don't have to break it down. I don't have to put all that money to work. It's kind of like turning on a dime type of deal. I can do that. Though it would be nice, though, I'm sure eventually I will. Probably after the next real estate cycle, I would probably be interested in getting into it. Just do the setting things up. And somebody's going to have to fill the places of these guys, right? Warren Buffett and Ray Dalio and all these, and you can see the other guys that are here now, right? They're not faring so swell, NASDAQ, okay, so here we are, NASDAQ at the old all-time high type of thing, poked its nose through. Look here, 86% of them were bullish going into 14. We only got to 84%. So even at a new high on the NASDAQ, it just didn't happen here. And we're rolling over. I would look at a hard slide here, probably under 30%. This is off of stock charts, okay, and like I said, I have them on weekly, and these are Heikin-Ashi bars, so they kind of, it's not so choppy for the eyeballs, because I basically look at something for a second and then move on. Like with here, there's a tipping point. Obviously this is it. It's hit it before and it rolled over. Okay, so you're looking for the hard sell-off to come into the NASDAQ. I would buy those too. Russell, some sort of mid-caps type growth. But basically, the economy's, if it follows the macro cycle here, the economy is going to be driven by homes. But of course, it comes back to now you have the baby boomers. Are the kids going to stay in the homes, their parents' homes, move back in, sell it off? In theory, we need to be moving brand new homes, new construction, growth in population. I talk about America is down to, I think, 1.88 kids. And Mexico is actually at 2.44, I think. They are at where America was in the early 80s. Fewer kids, labor, everything balances out. As bad it is, I'm a laissez-faire guy. The markets will take care of themselves. Yes, the Federal Reserve is needed at times. The whole ZIRP, and that worked out just fine. But most of the time, tinkering with the markets for a centrally planned economy, you don't have to do it. The markets will take care of themselves. The Fed usually trails anyway. So, all right, industrials. All right, smokestacks, a stronger dollar going forward. It'll be difficult for the smokestacks, but you are seeing mergers in like chemicals. You will see a lot more mergers here. But like I said, a stronger dollar is going to be difficult for exports and repatriation of dollars here. When you're doing billions and billions and billions, every penny counts, and the currency repatriation. But there's always some sort of excuse, right? It was the currency market, it was the weather, but you know, the industrials, they peaked back here with the commodities. You know, there's 2011 with the highs up in here. This was quite the interesting thing here. Okay, higher for their wares, and now we're getting a little bit lower. Okay, so hard slide. I would assume we're going to go under here on a hard slide here. I'm not a fan, but if you're, you know, a portfolio manager looking, you know, 10, 20, 30 years out, this is going to be one of the times to get into it prior to the cycle. It's kind of like buying copper miners and stuff through the 80s and 90s. A lot of dead money, but eventually it paid off. Transports. Okay, transports just did not, it's, you know, if you're a Dow theorist, did not, you know, the transports were failing. You know, you have to rotate the money. So if the money is going to come out of utility, maybe it'll go into the transports. But, you know, it's a market of stocks. Okay. So I would probably, since a lot of stuff goes by shipping and intermodal, I think what 95% of goods goes by ship. So you have, you know, we haven't seen shipping take off yet. They're back to storing, you know, stuff in the ships because they're cheap. I haven't looked at the Baltic indexes lately. But, and, you know, shipping and trucking and things of that on weakness, you know, for that would be one too, because if we're going to build homes and things, if everything stays on, you know, historical cycles, you'd want to be into the trucks because they're going to be moving the goods. But for right now, the transports just didn't come through. So now you have the utilities off, the transports never happened, and the Dow coming off. So you're going to start having some sell signals here in the Dow theory. But I would probably go after the just because they didn't participate now. Any hard slide, I'd probably go after the transports again. Okay. Come on, you. Energy sector. Okay. So the commodities one, charts that I'll look through. Oil is short-term overbought. Do I think it's going to go back into the 30s? I don't think so. But plus or minus around the $40 area, I said I could live with. But for right now, I think we have a cap on it at that 52 to 54 area. I'll just say 55 because, you know, if it goes over at 55, then I can start talking about it in $5 ranges. But now it's like, you know, 48, 47, 46. It's dollars each way, so which is nice for trading. We talk about taking 60 and 80 cents there. It's at 600 and 800 bucks, you know, that per contract. So that's, you know, it's if you want to, you know, flip these things, oil be at the majority of the time markets go sideways. You have 5 years of it. You have your, you know, set alarms in like above 85 and set alarms down here below, into the upper 20s, you know, and basically you can play it like this. You know, I talk about oil being dead money. It's like through the 80s and 90s, that kind of thing. But and because of where oil's at, any type of, we'll say, geopolitical, and can get it through 52, then we can start talking about higher numbers, and that's just a tradable thing. Of course, that'll affect the economy. Hey, guess what? If oil goes above 54, you can start, you know, the inflation thing. We're needing some sort of excuse to raise interest rates so we can jam the economy into a recession. Like I said, I'm looking for a recession somewhere around 2020. That's just because of all these other cycles. In theory, we should have a good year next year in equities. Okay, bumper crops in that, a mild winter and things of that nature. But by 2018, things should get a little heated per se. Okay, we could have more baby boomers coming out, more people who won't get off the couch and get a job until they actually get a decent price, and that's what it is, and then what happens, then they get a job and they're spending on stuff that they don't need. But it's been, people are going to need shingles on their roof, paint jobs, so time helps out. And take Italy, for example. Unfortunately, they had another earthquake, but that's the kind of stuff that they need for growth over there. Rebuilding, it's unfortunate, but it helps out the situation, economically. People need food, water, and shelter. So it could be a good thing, though, too, is that Italy is kind of a country like, where you all of a sudden you get technology, new technologies can be used there, because you don't, it's not like America, when we're trying to move oil across country or gas. I mean, we're talking thousands of miles, right? Our rivers are going the wrong way, up and down. Okay, that's fine. I mean, the Mississippi, yeah, we have that, but then all of a sudden rail, we're moving, you're moving wheat from Duluth all the way across to Portland. It's like, so it's, with Italy here, they could actually go, we could say 100% wireless, right? And that kind of thing. So Italy they may have a Renaissance type of deal. So, just like the Chinese symbol for crisis also means opportunity. So you look at both sides. But for energy here, as of right now, I kind of like stand aside, because I'm the type of guy that shows up and when there's major turns kind of thing. New York Stock Exchange, here's the interesting one here. It peaked. New York Stock Exchange peaked in May of 2015, but obviously the amount of issues there did not. Okay, so we got the 71s, which is up in here. I just think the smokestacks and everything, there's gonna be mergers and stuff, chemicals, whatever. Big names are gonna merge, cut labor, which means that now we have that to contend with. That's usually what they do. They merge. They can hold on to prices as prices fall. It's like I said, the macro cycle of the secular commodity cycle is over. And I prefer technology and growth versus the old smokestack stocks, the old conglomerates. That dollar is going to be an issue. And 95% of the world is over there. I think Coke gets 80% of their earnings overseas, and McDonald's 74%, and things of that nature. So here's our staples, just like I got done talking about, right? Things that you buy all the time, not happening here, okay? And that's not actually a good sign, because of these are staple stocks. These are usually like quote-unquote defensive type of deal. I am seeing some interesting marketing with Coca-Cola. They tried everything, the whole 12-pack thing. We talked about pricing. I pay the same amount today for a case of soda pop. That would be pop. Soda's out of the fountain, right? Coke today that I did back in the 80s. Okay, about $5.99 a case. Okay, so that's $3 a 12-pack. I can actually get it cheaper than that too. But they've, their logistics and everything, it works for them. But they're trying different marketing attempts. Soft drinks, number 2 now. I think water surpassed it. Americans go through 25 million water bottles an hour all the time. Okay, so when you have some staples here, things change. There was a saying at one time, as goes GM goes the country. Well, GM went belly up, and we did a pretty good job of getting close to it. But there's always, like the Great Depression, even though a third of the people were unemployed, we still marched forward, and we eventually found them a job. What was I reading that I thought was interesting? Oh, it said that the Canadian military, they're overweight. I just, okay, you look at that, and I'm like, that's an awful thing to have. I mean, you can't fight a war because you're overweight. It's you know, I'm looking at it from that ethical standpoint and the moral side too. You know, the games that we play, but you know, now that we have drones and things, it's not as massive, but we're still, you know, carpet bombing people and stuff. So it's, you know, it's almost like we're working on another one here. So the staples, you know, this isn't a good sign here. This is basically saying that people they're not eating and drinking, they're not doing their own, you know, this may be telltale signs that the economy is beginning to get soft. You know, people are, you know, making sandwiches instead of ordering off the dollar menu. NASDAQ, okay, here we are, NASDAQ. We go to the world famous all-time high, and guess what? Not as many issues. It's the money's piled into just a few, and of course that helps. That does the index too, just like with the Dow. A dollar move in $100 stocks affects the Dow the same way. Same thing. Yeah, large percent. Like when Apple was a large percentage, it doesn't come through. Same thing again here. I would, you know, once it starts the technology, since I want to kind of be in this area. Somewhere around in the 40s down here, selective. You know, I wouldn't go after Apple unless I was going to flip it. You know, I prefer, like I said, I prefer the indexes. It's a lot easier just to say which way the market's going. S&P 500, same thing. You know, if you take the 40s here, you know, you just say your tipping point is at 50. Go from there. And you can get these charts for free here, just punch in the symbol. You can also since they use point and figure, you can make them point and figure, but since not a lot of people follow point and figure, which I believe is probably the best charting because it keeps you in the trend the longest. You may miss the bottom, we'll say 10% off the bottom, okay, kind of thing. Okay, and you can fine tune it too to be a little more sensitive, like percentage in that instead of straight up traditional. But it keeps you in the longest. Once the little trend line comes underneath the low, you're in. There'll probably be a retest of the line further up the road after everybody goes, wow, and then you support it there. You support it twice off the underlined line on there. And then all of a sudden, if you look at the S&P, and it'll be in the next video, it'll poke its little head through and you may have a bull trap in the S&P. Here's consumer discretionary, the same thing here. This is when we decide if we want to go and buy a car or a new refrigerator or cruise, that kind of thing. It's, you know, so both staples and that. So we're, you know, the thing we're going to have to cross our fingers for here is the holiday season. So, you know, we'll do some shopping. It may be different that it's all spent on a meal or, you know, when I go to the grocery store, I take a look at what's in the shopping carts. Okay. Gives me an idea if they're really packed, the people feel that they're wealthy. Humans are a tough crowd. When it comes to managing money, I think 80% of them only have $200 at the end of the month. 90% of them, if they need a $400 car job, they don't have it. What was it? 80% of NBA basketball players filed bankruptcy 2 years after leaving. One guy had $110 million and now he's serving coffee at Starbucks. That's one of the main reasons why I'd want to probably get in the money management business. Just to, you know, 70% of lottery winners are broke after 5 years. I mean, it's on and on and on. They can't handle it. People revert back to what they know. So if they've had a rough life their entire life, more than likely they stick with it because they know how to get through it. You hit the lottery, you don't know how to manage it, you go insane, and you're broke. You know, but then you're back to what you can handle. You know, that's how it goes. So the discretionary, same thing. Okay. The more I look at these here, the more it's bad news. Okay, here we have utilities. You know, that the utilities, they were chasing after it for the yield because there was, you know, there's not much paper out there to purchase. You have to find yield. They went after that. I noticed the high yielding bond indexes are still up there. We had that game played in the 80s. Junk bonds, remember junk bonds? To do these buyouts. I mean, look, we have all this cash overseas, right? So if you can swing some sort of junk bond deal to get your fingers in that cash, you take it private, whatever, suck up the cash, you know, and then refloat the issues. What we have another one. I think M&A has been strong this year, mergers and acquisitions, but IPOs have lagged. And for the life of me, but it's just who I am, I guess. When you start seeing things like Snapchat and all these other oddball stuff, and they say that they're going to go public, but we're talking months out there floating it, I'm thinking to myself, you're a little late. I am amazed. You know, it's just because of who I am. You know, this kind of stuff kind of came naturally to me. You know, and then when I, you know, looking at the charts came natural. It was more than when I got into the cycles and stuff. But when I read the market, when I listen, everything's the same. Every top in Beanie Babies and real estate and gold and it all sounds the same. You know, if nobody wants it, I want it. If everybody wants it, I don't want it. Okay. You know, it's kind of like equities. I don't find equities overpriced, but they're just not a deal. I would rather go after shorting debt, which is, you know, when you're talking ZERP and NERP, I mean, you're talking things that haven't happened. I mean, interest rates in Great Britain, you know, 400 years, okay, that they haven't, that was when it started, Bank of England. So, I mean, we're doing some stuff here. I mean, it's kind of like lying to yourself. You have negative interest rates where, you know, maybe Earth is peaked. You know, I'm looking at this as a cycle thing, you know, real estate cycle, you know, 18 years. Droughts and hard winters every 4 years, and commodity cycles 3.5 to 4 years, that kind of thing. You know, like leap years, and I want, you know, things go, to me, everything goes in cycles. It's just how it works out economically. If oil's high, everybody piles into oil, then everybody's piled in and the bottom comes out. That's just how it goes, you know. But the utilities here, this was a hard sell-off, obviously. People are going to actually hide into utilities going after the dividend. But if you're losing 10, 20, 30% a year, it's going to be a long, long, long haul in the utilities. There's going to be a lot of change there too. You know, we're doing eventually, right? I mean, if you really think this one through, can we harness, you know, solar, you know, and wind, and we did a hell of a job with water, hydroelectric, right? To the detriment of the salmon, but you know, there's going to be, you know, they don't have the monopoly like they used to, you know. So, and it's a market of stocks, you know. If it's tough to, you know, if they offer 6 and 8%, that's all fine and dandy, but we're talking a long time on that compounding interest here. You're talking, when you buy these things, you're going to swallow a hard capital loss, but over time, 30 years plus, then the dividends and everything will help you for the next swing higher. You know, if the economy, think about this one too, you know, they ran into the utilities, and this could be a large macro cycle too. I mean, if you go and look at the Dow Utilities chart and look at this may be it for, you know, something comes out, some revolutionary, that we finally figure out the fusion, whatever, cold fusion. There you have it. I mean, or like I said, Earth peak too. And things are getting more efficient, and, you know, on and off with air conditioning and, you know, all kinds of stuff. So, and, you know, nukes are expensive. I think we had our first nuke come on board in a while. But, you know, it's a market of stocks. So the utilities, they may hide here if equities continue to roll over, but I would be interested in playing the short side of these things here. Okay, utilities, materials, same thing again, except for this one's moving quickly. I'd probably probably come into the materials here for the home building boom. But it looks like there's a pretty good setting down here. And I mean, look at this. We're talking only 3% of the stocks in the index were bullish. So this can get pretty hard oversold here, and we're past the tipping point here. So I'd look at anything hard down here. I'd probably come into materials. Healthcare coming off of a high and just dropping precipitously. Yes, we have the baby boomers, blah, 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 but it's one of these things that it was fully priced forever kind of thing. Some of them are still up there, healthcare. Some of them are falling apart. But it's a market. You know, if 47 million people don't have insurance, somebody's going to have to pay for it. If somebody probably isn't, that's what I'm seeing. You know, if you get national health care, it's just I'm already paying FUTA and SUTA and FICA, toss on another line. I'm not going to miss it. I feel good that I'm helping everybody else out. You know, but it just seems like obesity. You know, I mean, it's almost like there's some nefarious behavior going on here about this here. You know, if you can't afford a gym membership, you're not worthy of health care. You know, but it's anything for an idea or talent or whatever. You know, we're all on this planet together. We might as well get along. Gold miners, I think, is the last one here, and so much for my 20-minute video. All right. I'll do a video here on commodities next. And I talked about the downside of gold that I thought it was going to, I'm looking at the macro level. Okay. So that's one, so I'm looking at this as a cycle here, actually. So I'm looking at it and said, okay, I think gold's going to go down to $681. That's the next target if it loses 1050 again. Okay. So here's my thinking on this one. I looked at silver, and I thought that they could probably run it higher. For where we're at, I mean, think about it. You know, why would we buy gold and silver if we thought the economy was going to roll over, that kind of thing? But what I'm thinking is that I had a target of 1400. Okay, and you could have a thing, say like natural gas, where it did come off the bottom, and then they chased after it, and then they got pummeled. So it's the same kind of thing here in gold and silver. We chased after it for, you know, the shorts were right, but then they get caught. Okay, and like I said, these funds have been bullying them around, and I'll show you that in the gold chart. I think it was in March. All of a sudden, the unbalanced volume just came out of it. I hadn't seen that before. And I'm like, wow, these guys can actually turn on a dime. Usually when the large traders put on positions, it takes some time. But it looks, I mean, these guys are getting this stuff off and turning. I mean, 1 week you go from like record longs to all of a sudden you're flat into short. It's like, wow. So I'm thinking here that we get, I'll know by Tuesday, of course, because of how I'm looking at it, is that we do get a swing, I think maybe leading with the white metals, silver, platinum, and palladium up higher on a pullback of, say, the dollar. I'm treating the election like it was 1968, which was an interesting time too, because we came off the gold standard then. But if we had the dollar come off, like the world isn't too sure about America, and the dollar comes off, and metals and stuff take off, okay? You know, all of a sudden we get a dollar-denominated rally. It's not as much as economic, but it's more, you know, trading. Remember, a lot of these things are settled in cash. Commodities are settled in cash. So all we're trading whatever, say natural gas, but it's settled in cash, or pork bellies. You know, if I try to corner the pork belly market, all I'm trying to do is corner the cash market. You know, there's no exchange for physicals kind of thing. You know, so that doesn't really help out the market either. I mean, we might as well just have one thing. You know, in theory, that's the only thing you really should do, is you should find one thing like a future, SPX or QQQ or something, to follow the one and know it. That's your best bet for trading. The brain can only handle 6 things. So when I start talking about mostly when I talk about puts, you know, naked puts, or some sort of, we'll say bull put spread, some sort of deal, like it throws people for a loop. It's, you know, negative, negative, you know, I'm long and negative and short of negative, you know, it throws people for a loop there. So, but the gold miners and stuff, I'll go over the next video I go over. It'll be on the commodities, and it's more of like a tradable bounce. I don't see it going higher, but if the dollar does come back and we get oil to go back up through 52, at least clearing the 50-50 level to go, okay, we're playing this game again, get it through 52, oil takes off, gold takes off, some of the other commodities take off. Soybeans are a special situation. I'm beginning to warm up really hard to wheat. Okay. All of a sudden we have that inflation thing going on. So we could fight some inflation talk next year, you know, so. But I'll leave you with that, and then thank you again for making it through the video, and thank you for those of you who subscribed, and those of you who passed on your email so I can send stuff directly to you. Have a wonderful Sunday afternoon.